Folks, what is up? I'm here in the dungeons of my in-laws because it's basically the only place that's quiet in this entire house, away from the madness of the kids and all the other fun stuff happening out there. So forgive me if you see any laundry, because I am literally next to the laundry machine here. But what's more important is what I'm going to discuss, which is basically the year end of the financial and economic markets and what I think is going to happen into the next year. And so let's start off with what I was talking about in the thumbnail, which is the most accurate indicator in all of economics. And I challenge you to tell me one that's more accurate than this, which is the yield curve uninversion. Now, this thing doesn't happen that frequently. If we look at this chart over here, you can see that in the past, what is this, going back to 1980. So we're talking over 40 years, the yield curve, which when it inverts, turns red here, has led to recessions, which is what you see in the gray bars over here. And look at this. Every time we've had an inversion, and then when it uninverts, that's actually when it gets dangerous, is when it gets back out of the red into this aqua color, is when trouble starts and when the recession typically tends to strike. And so here we have it happen over here. You know, it uninverted over here. We had the recession. Same thing happened in 1990, same thing happened in 2000 with the dot-com bust, same thing happened in 07, 08, which was that great recession. That was really painful. We had a blip of an inversion back in COVID, right? It dipped here, and then now we've had this long period of an inversion. And what this is foretelling is, guess what? We're probably going to have a recession, and it's probably going to be a significant one given the length of inversion and the amount of the uninversion that's about to happen. The only time one can make a case was right around here back in 1998, 99, when it kind of had this blip, and debatable if we had a small recession or not. And that's it, right? Outside of that, it's been a very reliable indicator. And where are we at with that today? And if we look at an updated chart, we just uninverted, right? So we had a couple of head fakes over here where I thought that, it's uninverting and, it's going to go straight up. And no, we had this consolidation over here. And most recently, right, in the last couple of weeks, we've uninverted and stayed uninverted. So that means, you know what that means. We're going to have these gray bars, a gray bar, a nice thick one, I would think, showing up, meaning that there's going to be a recession. Now, if you look at this data down here, it doesn't mean that the stock market is going to collapse right after the uninversion. In fact, you can see here in the last 4 times that this has happened in the past few decades, it actually has gone up a couple of times. It went down in 2001 because it actually was late in the game, if I recall correctly. So we probably won't crash tomorrow just because we uninverted. We may go up even higher in what could be the final blow off top of the stock market before the recession hits, before we have some kind of a crisis, because there's usually some kind of a financial crisis that comes with these things. Maybe it's a banking crisis, maybe it's a currency crisis. We'll talk about some of these options. And then you get the bear market, and then things will start going down in a very, very painful period. All right, so what's been going on with the stock market is, look, I mean, it's so crazy how everything is concentrated to just a few stocks. We've never had that to this degree, I think, ever, right? So what that means is all the money is parked into a few handful of stocks and everybody's on one side of the boat. If you look at the S&P outside of you take away like the weighting of the Mag 7 and just look at the value, right? It has been going down quite a bit. And this was happening way before that crash happened just a couple of days, last week, a couple of days ago. And so that was telling me like, hey, this is way concentrated into, if you look at the Dow, which had been also going down in a streak, and look at the value of S&P, which is more equal weighted down, basically the Mag 7 was holding the entire stock market up, which is not a healthy thing, right? It doesn't portend to things that happen in an upward trend, because what did happen was this. Now, if you recall, Powell came out and said, hey, we're going to, cut interest rates by quarter point, but what we're going to do is also tell you that we don't think we're going to be really cutting that much more, in so many words. Essentially, it was what they call a hawkish cut. Like, yes, they cut their interest rate down, but they delivered it with a hawkish message. And when that happened, we had basically a flash crash, right? Like this is the S&P index, right? This is not some meme stock or meme coin. When you see like an hourly bar followed by another hourly bar of this magnitude, that's essentially a flash crash. And basically what that tells me is everybody has their finger on their trigger. Everybody has their finger on the trigger. Everybody, and I'm not talking about humans, I'm talking about the algos, right? They've been programmed to have their fingers on the trigger because they kind of know we're at the end stage, end game of this entire bull run that's been going on for many, many, many years. And because of that, a small thing like this will trigger what we call a flash crash. And that's exactly what happened. And that was a pretty scary crash, right? You know, if you look about what's been going on, why that we had that crash, for example, and why everybody's fingers on the trigger, I mean, it's very expensive now, right? The stock market is at an all-time high in terms of how expensive it is. Index price to book ratio, right? We've never had a more expensive stock market. Now you can say like we've inflated and printed money and that's why things go up. Yes, that's true. But given the context of where we were last time this happened, you need to take, you know, take that into consideration. And I'm showing you this other data because you can't just look at one thing and say that's going to happen, right? So we can't just like look at this one thing and be like, hey, you know, recession is going to happen, stock market's going to go down. You can't look at it alone. You have to look at other supporting metrics and important information. And one of this is how important the stock market is, right? And it is very, very expensive right now. The other thing we look at is sentiment. And if you look at, and you know, you don't want to look at the sentiment of the professional traders because they don't represent, you know, basically the bubble. What you want to do is look at the sentiment of the dumb people, people like me, you know, the consumer confidence. So this is basically consumer confidence expectation of stock prices going up. So basically the dumb money, what do they think about stock market prices? Will they go up or down? And we're at all-time highs. So the dumb money thinks the stock market's going to sky to the moon. That is not a good sign, but that's basically what is going on as we close out the year into 2024, right? I don't like it when the dumb money all thinks we're going to the moon. That's usually when rug pulls happen. We already had one rug pull last week, and I expect there to be more along the way to the final and ultimate blow off top. The other thing that we've seen is everybody's on leveraged long ETFs, meaning like, you know, double down, triple down, quadruple down ETFs that are long, that bet on money that the stock market is going to continue to go up. And it's just been at this, you know, again, a record amount of people believing the stock market's going to go up, and they're putting their money through these instruments, which are levered long ETFs in the most and every. So it tells you that people are gambling, right? Because levered long means you're taking margin and leveraging out, so you could lose a lot more as well. So but they're going all in, right? And the amount of people doing it. So this is a very, very frothy setup in terms of, you know, investor sentiment and also investor activity. Then you look at how much cash allocation. Now this is cash allocation across fund managers that Bank of America has put out, and you look at it across the professional bank managers, people managing funds, the stuff that, you know, consumers buy. No cash, dude. That means there's no powder left. They've deployed all their cash into long. You know, all the cash has gone into long, right? So the question now is, who's going to buy the dip? Who's going to buy the dip if all the cash has been deployed? Less and less people, right? Dip buying is going to go down as cash continues to get deployed into these long equity stock instruments. And that means is when there's going to be a downturn, it's not the dip buyers who come in, it's the short covering that makes the prices go up. And you'll end up with like a very, very, you know, rip your face off type of, you know, explosion move to the upside after a fall because it's short covering. But those aren't healthy and sustainable recoveries, right? That's not dip buyers. Those are short covering people taking profits and causing prices to spike up, but nothing to do with dip buying as cash continues to go down. Now, if we continue on through my little suite of charts I wanted to show you here, Another signal I look at is basically how, how stupid are we? Are we like .com stupid? I think we're stupider than .com stupid. And .com was pretty stupid. Pets.com and all that stuff was really stupid back, especially with valuations back in the year 2000, which led to the collapse in 70–80% of the Nasdaq. But look at what's going on here. We've got Fartcoin. Now, I'm not going to explain the history of Fartcoin, but it's basically, oh God. We basically have Fartcoin, which has a market cap greater than 38% of all publicly traded American companies. Just take a moment and smell that Fartcoin in. That should tell you how stupid, the level of stupidity we've reached, right? Can it get stupider? Yes, it can. Yes, it can, because we're extremely greedy people. And the greedier you get, the dumber you can get. But we are nearer to the end than to the beginning. Mark my words on that one. The other thing I wanted to show you was the cost of protecting, right, your portfolio has only been, it's so cheap basically to protect to the downside because nobody thinks the market's ever going to go down. So it's so cheap to protect to the downside, which is, now we'll talk about my positions. I was in UVXY, which I told you I put a position in, maybe about 6 weeks ago now. And I actually never touched it until just a couple of days ago when I finally exited that position. And I knew, look, trading is not easy, right? So holding that for the amount of time, I had to hold it longer than I thought. I thought it was going to be a couple of week thing. And I could have taken profits of, a few $1,000s and done that. But I decided to hold on because I was looking for something more significant of a return. So I held it for over a month, right? And during that month, it was really hard because, Trump won the victory, volatility collapsed. I was down, percentage-wise, quite double digits easily. And, people were asking me in the comments like, hey, you're still holding that UVXY position. How much money have you lost? And my response was always, I didn't lose anything because until you sell something, it's all unrealized losses or gains. And, it's paper money. It doesn't mean anything until you actually sell it. And there's one person who kept asking me every time the market would go up. It's like, hey, how much did you lose now on your UVXY? And I would tell them how much unrealized I would be down. Well, anyway, I was holding it because I knew that volatility was so darn cheap that when there would be a downturn, which eventually there will be, it would spike. And basically that's what happened. The VIX index, when the markets tanked, when this happened, the VIX went up 70% in one day. It's like the 5th time that's ever happened in history. 70% return in one day is what I was looking for, and that happened, right? So that's why I exited my UVXY finally with a handsome profit, and I'm all happy with that. It took longer than I thought, but hey, when you're making tens of thousands of dollars in a single position, that's not bad. But you got to be able to be disciplined to trade properly and not worry about being down like 10, 20,000 on a $90,000, $80,000 because it's a risk vehicle that I put my money in. So I know that there's going to be ups and downs and swings, and it's just, it's not timing it, but knowing the price target that you're hitting. And it hit, and so I sold and made a good amount. And actually, what I did was I went long, right? So I actually have, I put into, and this is a short-term trade because I think we are near the top, but I do think we're going to have the blow-off top. Actually, so let's talk about this blow-off top, right? Like what I think is going to happen. So that's what happened with the VIX. I kept holding it because I knew it was super cheap and it was stupidly cheap, right? When it gets this cheap, volatility is going to just explode higher, and that happened. And so we're all sitting happy with that trade. Inflation is going to make its, look, I've been saying we're tracking the 1970s in terms of the inflation or what happened. And I think we're still doing it. That's why the Fed came out and was hawkish, right? Even though they cut rate. And that's what caused the market to tank because the Fed believes that this could happen, right? And they're worried about this. They're very worried about this. And so this could actually happen, right? And I'm watching this, and it's something we need to watch in 2025 going into 2026. Look, if we track this, like we're talking about a couple of years of, extremely high inflation, which would be devastating for the market. And how the Fed handles this, I don't know. We don't have Paul Volcker there anymore, right? We don't, as much as Powell thinks he might be. I don't think he is. The other thing that's going on is from when you have like BlackRock, which is the biggest asset manager in the world, saying, "Hey, the world economy has exited the boom and bust cycle," that tells me that yeah, we're also very near the end, because this is basically saying, like a physicist saying, "Hey, we finally exited gravity." It's like, no, you can't. You don't. That doesn't happen, right? We haven't debunked gravity, which is what they're basically saying. And the hubris, right? And to say such a thing and slap your name of BlackRock on such a statement is just simply ridiculous, if you ask me. No, we have not exited the boom and bust cycle. We are not in a boom only forever and ever. It's not a cycle or a line anymore. That is absolutely asinine, if you ask me. So the other thing I want to bring up is what's going on around the world as well. We can't just look at the U.S., right? Even though it is the largest market. Look at what's going on in China. China is, and this is what what's going to happen into next year. China is just in all kinds of issues, right? Their yields for the government bond has never been lower, even lower than in the 07, 08 collapse, right? And so, China's in a world of hurt. They don't know how they're going to restart their economy. They're going to try and do quantitative easing / maybe start a war. Who knows? But it's not just China, right? It's all the other developed economies. They're just like the U.S. in so much debt that they don't know what to do. It doesn't matter. You talk to Trudeau up in Canada, whose finance minister just quit. I mean, he's doubled down on debt, and Canada is suffering, right, as an economy. Then you go over to Europe and you look at the largest economies like France and Germany. It's way too much, or you include the UK if Brexit, way too much debt, and they're trying to cut interest rates, right? While the Fed is trying to maybe not cut as much. And so again, we're going to have this discrepancy between what the Fed is doing and what the rest of the world is doing. Don't forget what's going on with Japan and the Bank of Japan and the yen carry trade scare, which tells me, look, all in all, the room is still filled with really, really highly flammable gas, right? And, to sit here and pretend you know what the spark's going to be is complete BS. Nobody knows, right? Nobody knows what the spark's going to be. But my point here is you don't have to know what the spark's going to be. You just have to know that the room is filled with gas, right? And prepare accordingly. Kind of just like I did with my UVXY and volatility trade. Like I knew volatility and basically protection for the stock market was super cheap. And I knew that's like the room being filled. Like you don't know what the trigger is going to be to revert to the mean. No, you don't. But you just know. So you just put your position in and you just wait, right, for the room to explode. Like the room may not explode, it is, but that's very low probability, right? And so it eventually did explode. You have to be patient, it can't be trigger happy. And when it did explode, look, boom, VIX exploded 70% in one day, right? And then that's it. And similarly, in a broader context, the stock market, it's filled with gas, right? The economy, everything I've showed you so far, the room's filled with gas. What is the trigger? I don't know. Could it be the yen carry trade? It could be. Could it be some other currency crisis because of what's going on around the other developed economies like OECD? Possibly. Could it be some like geopolitical event? Absolutely. Look at what's going on with Ukraine and now it's Syria, the Middle East. That whole thing in Syria, you got to be careful because Syria is like, okay, I'm not going to go into it, but it's basically like, a free-for-all region in the Middle East, right? And you don't have a slowdown with Ukraine. Basically, Russia's winning, right? They've unleashed into Kiev directly more ammunition and more bombs, so that's escalating. Who knows, right? There could be a geopolitical event, right, that throws us under. It could be the debt that a lot of the banks, the regional banks, are sitting under. What happened with Silicon Valley National Bank still is, it's just been parked underneath, right? And if the Fed has to not cut rates as much, who knows, right? Like that could. So there's a myriad of things that could trigger the explosion. but we don't have to pretend to guess to know what that thing is. We just need to know that it's full of gas and it's going to explode. Chances are it's going to explode. A lot higher chance of that than it not exploding, right? Because we always see sparks happening. I do want to spend a brief moment because a lot of you have asked me about gold, right? And so I'll tell you about gold. Gold has basically had this tremendous run, right? This is a one-year chart of gold, and it had a tremendous run, and now it's consolidating. I expect it to consolidate in this range, right? Just like it kind of did here. I don't think it's going to consolidate this long, but it'll consolidate perhaps a little before its next leg up. And that's actually not too different from what Bitcoin has been doing. And I don't want to talk about Bitcoin in this video. Like I said, I do hold both Bitcoin and gold, although my holding in gold is a lot larger because it's safer. And Bitcoin's kind of like another risk asset type of thing. But obviously Bitcoin's been doing well, so I'm happy with that as well. But I expect gold to be, again, this is a secular bull market, and it's going to continue to go up over the years coming. Especially if what I think is going to happen when the room explodes from the flammable gas happens, there will be a dip. But I'll be buying more of the gold when that happens. The other thing I wanted to just talk about is, the rise in the dollar, right? And so that's another thing to keep an eye on, because when the dollar rises, that's not a good thing. I know it's counterintuitive, but when the dollar rises, that means bad things are happening in many regards. So watch the dollar, see how it's going, look at gold. But ultimately, folks, we are in for and let's go back to the beginning of all this. Right? We are in for a very tough couple of years, right? And you need to be able to prepare. So when I say prepare is, what is the time horizon you're looking at? Are you looking at it a month? Are you looking at it a quarter, half a year, or multiple years? And, put your investments and allocate your capital accordingly. Like for me, I have the long-term thing. For me, that long-term thing is gold, where I, have a lot of my assets in. Then I have more short-term things, which is, when the room explodes because of flammable gas, I'm preparing for that. So that's kind of like, quarterly to year type of time frame, like, a year or under. And then I have even shorter time frames where, I put some of my capital into trades I want to get in and out of in a few weeks. And that was kind of like the UVXY trade, which lasted longer than I thought. And I'm in a trade now where I put money in to ride what I believe will be a final blow-off top of the market heading into Trump's inauguration in late January, and try to ride that up and make some cash. So I have a position there, and we'll see how that goes. I do think we may hit all-time highs again on the S&P and hope to make some money on that ride before everything comes crashing down and the party gets started with the recession and the bear market. So having said that, I hope everybody has a wonderful holiday season. I love coming to the U.S. when it just snowed this morning and last night, so there's no snow in Bali and Singapore. So this cold weather and the snow is something I really cherish. And till the next video, peace out.